let's get right to it. We're looking at Canadian Solar, ticker CSIQ. And right now, this company is standing on a knife's edge. On one hand, they are pouring billions into building a manufacturing empire right here in the United States. It's ambitious, it's bold. But on the other hand, their financials are flashing some of the biggest, brightest red warning lights we've seen in this entire sector. Here at Iron Financial, our job is to forge through the noise. And the question we have to answer today is pretty simple, but it's critical. Is Canadian Solar forging a foundation for total market dominance, or is this whole grand structure they're building about to come crashing down? This is a huge story of ambition versus cold, hard reality. So let's get in there and start digging. So here's our plan of attack. First, we're going to tackle the solar downturn paradox. Basically, how are they spending billions when they're bleeding cash? Then we'll look at the blueprint for their so-called U.S. fortress. This is the whole bull case. After that, we find the cracks in the financials, and trust me, there are cracks. Then we'll try to make sense of Wall Street's completely mixed signals. And finally, we'll bring it all home with our final verdict. Is this a massive opportunity or just a dangerous trap waiting to spring? So let's start with the thing that makes this stock so weird and so risky. The entire solar industry, globally, is in the middle of a nasty downturn. There's a flood of cheap panels, mostly from China, that has just canked prices. I mean, margins are getting absolutely vaporized everywhere, and we're seeing weaker companies go belly up. And yet, right in the middle of all this carnage, Canadian Solar decides, you know what? Now's a great time to launch a multi-billion-dollar expansion. It just doesn't compute. How does a company post these huge losses and then immediately pivot to one of the biggest, most expensive projects in its history? It's like deciding to start building a skyscraper right as the hurricane makes landfall. It's wild. And look, this slide really tells the whole story right here. It's the promise versus the reality. On the left, you've got the story that management is pushing, right? You hear about record shipments, this huge American expansion, a record backlog in energy storage. If you only read their press releases, you'd think this company was an unstoppable juggernaut. But then you look at the reality on the right side of the screen. The actual numbers. And oof, Q4 2025, they didn't just miss earnings, they lost $1.66 per share. That's a huge loss. And revenue, it didn't just slow down, it cratered, down a full 20% from the year before. And the cherry on top? Their forecast for the next quarter was a big miss too. This isn't a little stumble, folks. This is a chasm, a huge gap between the story they tell and the reality of their books. Okay. So with all that bad news, you've got to be asking, why on earth would anyone touch this stock? Well, this is why. We have to look at the bull case. We have to understand the strategy. Because as risky as it is, there is a logic to it. And that logic is all about building an impenetrable fortress right here in the North American market. They are making a gigantic multi-billion-dollar bet that made in the USA is the future. They believe that by bringing manufacturing home, by creating a supply chain that starts and ends in America, they will absolutely dominate in an era of trade wars and global instability. It's a huge, expensive, and potentially game-changing bet on American energy. So let's talk about the first steel beam they're putting into this fortress. It's their energy storage business, called e-storage. And you see that number? $3.6 billion. Now let me be crystal clear, because this is important. That is not some pie-in-the-sky sales target. That's not a hope or a dream. That is the value of legally binding, signed contracts for their battery systems. These are real orders from real customers. In a market as wild and unpredictable as renewables, having this kind of guaranteed future revenue is like gold. It's a solid steel pillar of predictable high-margin income that they can absolutely build around. It's maybe the single strongest part of the whole bull argument. And then there's this 10 gigawatts peak. I mean, just to put that into perspective, that is a colossal amount of manufacturing power. That's the plan for their Texas factory alone. But, this is where the skeptic in me kicks in. It's one thing to build a giant factory. It's another thing entirely to sell every panel that comes off the line at a profit, especially when the market is flooded with cheap alternatives. This feels a little bit like that classic, if you build it, they will come strategy. It's a massive gamble in future demand that just isn't here yet. So the question is this a brilliant visionary move, or is it just a reckless, ego-driven bet that could sink the whole company? And here's the answer to that very fair question. See, it's not just about slapping together modules in Texas. No. The real strategic chess move is right here. 6.3 gigawatts of American-made solar cell capacity. By building their own cell factory in Indiana, they're not just assembling here, they're manufacturing here. This is the key that unlocks the whole fortress. Suddenly, they're insulated from Chinese tariffs, they're insulated from shipping chaos, they're insulated from geopolitical games. This move alone would create the biggest crystalline silicon footprint in the entire country, giving them a massive structural advantage that companies still importing cells from Asia just can't compete with. This is about building a self-sufficient machine. And look, this isn't just some pipe dreams sketched on a napkin. They've laid it all out. It's a blueprint, a step-by-step battle plan. Step 1 is already done. The Texas factory is up and running at a 5-gigawatt rate. Check. Step 2, they fire up the first phase of the Indiana cell factory around April 2026. Step 3, later that year, they double the Texas plant to its full 10-gigawatt capacity. And then finally, Step 4, they bring the rest of the Indiana cell factory online. It's a logical, phased approach. It's not a wild gamble. It's an engineered construction project. And if you want to know the why behind all this money, all this risk, just listen to the man in charge, Chairman and CEO Dr. Sean Koo. This quote says it all. This isn't some short-term tactic to please Wall Street for a quarter. He says their commitment is steadfast. They want to spearhead the reshoring movement. That means they want to be out in front, leading the charge. They are betting the entire company on the idea that in the next decade, being the undisputed leader in American-made solar is the ultimate prize. Okay, deep breaths. That's one heck of a story, right? A U.S. fortress, leading a manufacturing revival. It's powerful stuff, gets you excited. But you know what we do here at Iron Financial? We don't invest in stories. We invest in balance sheets. And a beautiful fortress on a crumbling foundation, that's not an investment. That's a death trap. So let's grab our hard hats and our flashlights. It's time to stop looking at the blueprint and start looking for cracks in the foundation. And wow, we didn't have to look far. In fact, this first number might be all you need to see, 0.63. That is Canadian Solar's Altman Z-Score. For those of you who follow corporate finance, you know exactly what this means. And folks, I'm not being dramatic when I say this is a flashing, screaming 5-alarm fire on the dashboard. This isn't an analyst's opinion. It's a purely data-driven calculation. And right now, it is signaling a severe risk of bankruptcy. So, what the heck is an Altman Z-Score? Think of it like a financial stress test for a company, created by a brilliant professor decades ago. It just takes 5 standard financial ratios, plugs them into a formula, and spits out a single score that predicts the likelihood of that company going bankrupt in the next 2 years. It's incredibly powerful. Now, a healthy company scores above 3. The magic number to watch for is 1.8. Anything below that, and you are officially in the distress zone. Canadian Solar at 0.63 isn't just in the distress zone. They are deep, deep in the danger territory. It's not a yellow flag. It's not even a red one. This is a code black warning siren. And that Z-score, it's not some random fluke. It's the symptom of a much deeper sickness in the financials. Let's just run through the warning signs one by one. First, their debt-to-equity ratio is 2.58. They are just buried in debt. For every dollar they actually own, they owe more than $2.50. That's terrifying in a high-interest rate world. Next, net margin. 0.27%. That's basically zero. They make almost no profit on billions in sales. But look at this one. Operating margin is negative. That means they are losing money on their actual day-to-day business of making and selling stuff. They can barely cover their short-term bills, and the value they're generating for each share is going down. It's just crack after crack after crack in the foundation. And if you want to know where the pressure is coming from, look at this chart. Just look at it. This is the heart of the problem right here. This is their gross margin, the basic profit they make on selling a solar panel. In 1 year, it has collapsed from over 14% down to just 10%. For a manufacturer, that is a death spiral. It tells you everything you need to know about their power in the market, and the answer is they have none. They're being forced to slash prices just to compete, getting squeezed on both ends. Their core ability to make money is just evaporating. So you ask the company, hey, what gives? And you get the classic trifecta of explanations. They blame lower sales volumes, delays in selling their big projects, and having to write down the value of some of their other assets. So let's translate that from corporate speak. What they're really saying is, the market is tough, we're not closing our deals fast enough, and some of the stuff we already own is worth less than we thought. That is not a great combination, is it? It's a mix of a bad market and bad execution. And that can be a fatal cocktail. So you've got a company with a Z-score in the toilet, drowning in debt and bleeding profits. The smart money should be running for the hills, right? I mean, every professional analyst out there should have a big fat sell rating on this stock. Well, you'd be wrong. And this is where the story gets truly bizarre. Instead of running away, Wall Street seems to be completely and utterly confused. I mean, seriously,
Look at this. How are you supposed to make a call on this stock when the folks who get paid 6 and 7 figures to analyze this stuff are this far apart? This is from the same month, by the way. On one side, you have UBS saying this thing is going to $37 a share, a massive gain. At the exact same time, you've got JP Morgan saying, nope, this is a $10 stock. That isn't a simple disagreement. That is a financial civil war. When the pros are this divided, it tells you that the outcome here is completely binary. It's either going to the moon or to the graveyard.
And here's why the smart money is so tied in knots. It's the classic valuation paradox. On paper, this stock looks like a screaming bargain. Its price-to-sales ratio is a tiny 0.21. The market is valuing the entire company at just 1/5 of its yearly sales. That's dirt cheap. Its price-to-book is 0.43. You're theoretically buying the company's factories and inventory for less than half of what they're worth. That's what gets the value investors salivating. But then you see that forward PE is still over 24, which means the market expects big earnings growth down the road. This is the definition of a value trap, folks. It looks like a Rolex on the sidewalk, but you're not sure if it's real or a cheap knockoff that's about to fall apart. All right, we've seen the glorious architectural blueprint for the fortress. We've inspected the foundation and found some terrifying cracks. Now it's judgment day. Let's put the bull case and the bear case in the ring, head to head, to forge a final verdict and help you figure out what to do. So let's argue for the bulls. What's the case for buying? It's all about the long game. It's a strategic bet on becoming the American solar company. If they pull this off, the sheer scale of their operation will create a massive competitive moat. And remember that $3.6 billion energy storage backlog? That's a cash flow anchor in this storm. They also have a plan to sell off some assets to raise cash, which could help fix the balance sheet. And it's a big if they survive, you're buying in at a price that looks incredibly cheap based on sales and assets. The bulls are saying, yes, it's messy now, but if you have the stomach for it, you're buying the future leader of American solar at a fire sale price.
Okay, but then the bear grabs the microphone. And their argument is simple, brutal, and based on the right here, right now. It starts and ends with that Altman Z-Score. It's screaming bankruptcy risk, and you ignore it at your peril. Then there's the mountain of debt, which is a ticking time bomb. Their margins are collapsing, which shows they have zero control over their pricing. They are burning through cash, losing money on their core business. And they're already admitting they are having trouble executing on their plans. The bears aren't looking at a blueprint for a fortress. They're looking at a house of cards in a windstorm, and they're screaming, get out before it all comes down.
So what's the bottom line here at Iron Financial? Canadian Solar is one of the purest, highest risk, highest reward bets on the market today. This isn't an investment, it's a speculation. It is a leveraged, all-or-nothing gamble on an American manufacturing comeback, smack in the middle of a brutal industry collapse. The bull case could generate life-changing wealth. The bear case could lead to a complete and total loss of your capital. And frankly, the data supports both outcomes. This will either be a spectacular success or a spectacular failure. There is very little middle ground. So we leave you with the only question that matters, the one you have to ask yourself before you even think about hitting the buy button. Is your portfolio forged to handle this kind of risk?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.